Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today, we're very fortunate to have with us Peter Miller of Invesco. Peter is the head of Client Investment Solutions for North America. His focus is on asset allocation strategies and comprehensive portfolio solutions across institutional and private clients. Prior to joining Invesco, Peter was a senior vice president with PIMCO's Financials Institution Group. He'll also be moderating our upcoming Insurance Investment Officers Roundtable event on December 4th, which will include investment professionals from Principal Financial, Genworth Financial, Alliance Bernstein, Apollo Global, and Neuberger Berman. Peter, welcome to the podcast.
Thanks a lot, Gary. It's great to be with you.
Currently, when you're interacting with clients, what are some of the top of mind topics that come up as far as investment challenges regarding their strategies?
Well, I think a lot of the clients that we work with now, the continued trend is ever more private market exposure and, really looking to find additional return, wherever they can, of course, in a risk managed way and really trying to underwrite everything that they're doing. But, it's just been really fascinating kind of watching markets evolve over last several years, and I don't really see that stopping. I think that's just going to continue, and a big part of that again is just sourcing private market exposure, kind of diversifying and complementing a lot of traditional exposures that they still have, especially when we're talking about institutional clients. And as part of that, the technology and analytics that go around that are a big part of that. And so I think it's both sourcing the exposure that our clients want, and then quantifying, monitoring, risk managing, all of it goes hand in hand with that.
What about, are you seeing an increasing shift towards outsourcing from the insurance companies in their decision making?
Yeah, I would say specifically for insurance companies, there's definitely a long history of managing a lot of their portfolios in-house, with their own in-house investment teams. And, that is still very prevalent, but there's no doubt that outsourcing has been an increasing trend for, really since the crisis, and that has not stopped. And even, the most sophisticated and largest insurers out there who have, significant resources, significant ability to manage a lot of their portfolio exposures internally, even they are outsourcing more and more, and that may not be, half of their assets. It may be a relatively small percentage, but that percentage continues to increase. And it kind of ties back to our first question around, private markets and ever more specialized, ever more esoteric exposures, where it really makes the most sense to work with an outside partner who may specialize in that particular area of the market. So that does continue, that outsourcing does continue, and I think it will only increase over time.
And once that outsourcing decision is made, what's the process of determining the optimal asset allocation for a client in the insurance sector? What are the key considerations, and how does that translate into the proper mix between equities, fixed income, and alternative assets?
Yeah, I think the framework and the process there, that's something that really hasn't changed, or at least it hasn't changed in any fundamental way. I mean, I think that's been consistent for many years, and it's always been a multifaceted or multivariable kind of process where insurance companies, of course, start with the economic risk return considerations and examining the trade-offs and making sure that, of course, on the one hand, they're seeking return. They want to get paid an attractive return on their assets, but of course, want to be mindful of the risk they're taking and ensure that they're not exposing their balance sheets to any undue risk. But of course, for an insurance company, once you consider the economic profile of any allocation, you certainly have to consider a lot of other things, such as risk-based capital. How much of your capital do you have to set aside to cover potential unexpected risk, to cover a potential loss? That's a regulatory thing. There's also a rating agency element to that, and then there are oftentimes accounting considerations as well. And that could be, whether it's GAAP for international carriers or IFRS, even tax considerations. So there are just so many additional variables that insurance companies have to consider when they're making these portfolio allocation decisions that go beyond just the economic risk and return. So that's what I mean when I say that fundamentally hasn't changed. I think what's changed is just, there are now so many ways to invest, and again, this is going to be a recurring theme, but private markets, things that aren't traded on a screen, things that are sourced maybe in a bilateral kind of private relationship driven kind of construct. Examining the risk, understanding the risk, being able to quantify what's under the hood and then track that over time, and then how that looks through regulatory risk-based capital lens, or how that looks through different accounting lenses. That's what's just continued to evolve. But I consider that to be, on the edges, and really that fundamental kind of multi-variable framework. That's something that's been around forever, and I think will just continue for a long time still to come.
How do you determine sort of what's the right mix between public and private market exposure? What are some of the variables that go into that?
Yeah, that's always a tough one, because I don't know that I would necessarily characterize it as being an optimal, as though there is a single optimal solution. I mean, I think a couple of key things come to mind that everyone has to consider when they're evaluating public versus private market allocations. And one of them, of course, is liquidity. I think a lot of people rightfully associate private markets as being relatively less liquid, than public market exposures. Oftentimes your money's locked up for a period of time, or even if it's not locked up, it's just harder to unwind, harder to exit positions. And so there's a liquidity consideration there for sure. There's also, again, a consideration around data availability and insight into what the underlying exposure is in the fund or in the portfolio for a private market allocation. And so when insurers or any investors are trying to evaluate what's the right mix between public and private exposure, you really need to consider all of those elements. And again, it's not to say that adding or increasing private market exposure or less liquid exposure is wrong. It just means you need to really go into that with eyes wide open and really have a good understanding of where things can go wrong, where things may get stressed. What types of scenarios are you going to have to really prepare for and be conscious of going in. And if you do your homework, if you do that right, then there certainly is nothing inherently wrong with kind of tilting ever more towards that private market or less liquid allocation.
And you just touched on it, doing your homework. How much has like technology as it's evolved been helpful in figuring out the right mix, and particularly AI? Is that much of the equation at this point, or is it still sort of early using AI to do some work in this area?
Yeah, well, technology, no doubt, has been hugely beneficial when talking about portfolio construction, when talking about combining public and private market exposures. I think a big thing, and something that we do a lot here, is think a lot about modeling and quantifying private market risk and private market exposure, and thinking about things maybe less in terms of asset class labels and more in terms of risk factor exposure. So what types of investments are exposed to interest rates and credit spreads, or different equity factor exposures. I think it's helpful to kind of think about exposures or portfolio allocations in that way, because it does lend itself to being a little bit agnostic to what the label is, whether it's public or private. So technology has been hugely beneficial along those lines, because there's so much data out there where you can quantify public and private exposure to those different types of factors. I think on the AI side of the technology question, that one is certainly newer and certainly early days. We haven't really seen widespread adoption of AI in a way that has really fundamentally changed what our clients are doing or what we're doing on behalf of our clients when it comes to portfolio allocations, asset allocation. I think very early days, but there's I think no doubt that AI, when used properly, can be a massive asset and a really helpful tool, just again to make things much more efficient for users who know how to deploy it, who know how to get the most out of it, and take a lot of the time-consuming kind of manual aspect of their jobs and automate that, and kind of leave it to AI to synthesize information on their behalf, and then kind of use their time and their energy where it's most beneficial. I think there's no doubt that AI is going to help along those lines, but it's going to take time. It's going to take, I think, still probably years, before it becomes really ingrained and really kind of used in a really widespread way, I would say.
And some of the outlooks for these insurance companies, how they manage their portfolios, I would assume is sort of longer term in nature. But how does the macro environment factor into when you're making decisions in the shorter term? How important is that?
Well, it is very important. I mean, you're right that most insurance companies, I mean, certainly for life insurance companies, they're generally dealing with fairly long-term obligations, long-term liabilities, where you could certainly frame it as they have the luxury of thinking over a longer time horizon than maybe some other investors, and certainly property casualty insurers and even health insurers have relative to life a shorter, typically a shorter time horizon or shorter liability profile. But I think regardless, even for life companies with longer term liabilities, there's just no question that you have to be mindful of what's happening on a day-to-day, month-to-month, quarter-to-quarter basis. You can't take your eye off the ball and sort of ignore what's going on around you in the near term, because certainly, of course, a series of short time horizons becomes the long term, right? And so you have to kind of think about sequencing. You have to think about the progression of shorter time horizons and what that might mean over a multi-year time horizon. So whether that's interest rates, which are probably the single biggest variable affecting insurance portfolios, given the heavy allocation to fixed income, but inflation, the broader kind of macro economic growth outlook, that certainly has implications for risk asset performance. And in the near term, even if you have a very long-term horizon in general, in the short term, you could be presented with some very real opportunities, right? You could find yourself in situations where maybe there's a market dislocation and you have the ability to buy attractive assets on the cheap that wasn't in your long-term plan. Or conversely, you could have a near-term drawdown or kind of risk-off move where maybe you do need to consciously take some action in the short term, even though, again, it may not necessarily fit perfectly with your long-term view. So, the short answer to your question, Gary, is while insurance companies are typically long-term investors, that's true. The short term is still very consequential to their portfolios, to their investment decisions. And there's no insurance CIO out there who is not very closely monitoring what's going on every day, every week, because they all recognize that there's risks to manage and there's opportunities that they may want to pounce on when the market kind of presents that opportunity.
You mentioned also earlier about back on the private assets. I'm assuming stress testing, scenario analysis are a significant part in constructing a portfolio. How has that changed that process? Has it had much impact?
Well, I think stress testing and scenario analysis have been around for a really long time, but it does kind of dovetail with our earlier topic around technology. Just the ability to, for example, let's say Monte Carlo simulation, where you can model something over thousands, tens of thousands of scenarios, to get a really good handle on not just what is my base case or my kind of central tendency or my central expectation, but really look at what are the tails, what are the extreme outcomes that are unlikely but plausible, right? And getting a feel for what's the distribution, of outcomes, or maybe thinking about things in probabilistic terms rather than very discrete, finite terms. I think that's uh, it's been around for a number of years, but certainly didn't necessarily exist and wasn't so readily accessible when I started my career, at least. So that's something that's been, relatively recent, I guess. And then, thinking about, stress testing. It used to be the case that maybe you would, look at a small handful of historical scenarios and look at, okay, what if my portfolio were to experience a repeat of this scenario, whether it was like a 94 rate hike or, 2008 and 9 financial crisis. Now technology allows you to look at, you know, really infinite number of historical scenarios, or you could, create your own hypothetical what if scenarios and kind of stress some of those things that we talked about earlier, some of those variables like rates, like credit spreads, like equity markets, inflation. You can stress test a lot of variables at once, kind of look at the interaction of those things. So I think that's where stress testing or scenario testing has really evolved, and where technology has really helped just make that super accessible, really fast, and really customizable. So it just allows insurers to be creative and think about not just what's happened in the past, but even kind of dream up, a lot of hypothetical what ifs that maybe haven't happened, but it's good. It's a good thought exercise to think through those kinds of things.
Peter, what about, climate risk, which I would think would fit into that category a little bit, stress testing, because we've got hurricanes, wildfires, just severe weather events. How is that affecting the insurance industry? It seems like it's more prevalent now. And how is that being integrated into risk modeling?
Well, that's a great question because, I think certainly climate, or at least certain types of climate events, right? So you think about hurricanes, it's something that's industry has, I think, gotten very, very good at modeling. There's some amazing technology centered around modeling for that type of risk, and um, you know, predicting. I don't know if that's the best word, but quantifying likelihood and risk, and again thinking about probabilistic frameworks. I think that's something that's been around, and always, of course, continues to get better and better. But maybe some other types of climate risk, to your point, are a little bit newer, or maybe a lot more prevalent in the coming 10, 20 years, um, than they have been in the past 10, 20, or even more years. And I think, again, that's something where AI, to tie back to that, that could be incredibly powerful. Just taking loads and loads of data, and synthesizing that, and then modeling potential outcomes, and then kind of adjusting, right, as experience unfolds, then adjusting and incorporating that experience. I think that's going to continue in prevalence. But I think, again, hurricanes is probably the single best example that I could think of in terms of climate-related events that have been around for a long time. There is a wealth of data and a wealth of modeling already out there. The industry has really done, I think, a very good job of capturing that, which is more of a kind of liability side of the house, a kind of an underwriting consideration. But then, of course, then that has knock-on implications for investment decisions, right? And portfolio allocations, and how you allocate money, how you invest in light of those kind of underwriting risks. So the investing side, to kind of bring it back to that, it certainly is important. But I think it starts on the liability side. It really starts on the underwriting side. And then it enables asset allocators to then invest accordingly.
And shifting to the regulatory environment, which is, I would think, another key aspect of this, where does it stand currently? And is there anything significant on the horizon that bears watching for insurers?
Yeah, so on the regulatory side, there are a lot of things that bear monitoring. And when we think about U.S. insurers, The NAIC, of course, is the body that really drives a lot of the regulation, and the states work with NAIC closely in implementing their own regulatory policy. Nowadays, if not number one on the list, I mean, certainly very high on the priority list, and something I think is going to continue getting a lot of attention is, again, there's a couple of elements of private markets investing. One is the increasing prevalence of private asset managers, alternative asset managers who own or have a lot of influence over insurance companies. That is certainly a big topic of conversation, whether it's from the other side, looking at insurance companies who are increasing their allocations to alternative investments, and from the regulatory perspective, the questions around, are they being risk managed properly? Is there enough risk-based capital being set aside for those? Should that framework change? Should the way that the regulator examines that change? I think there's a lot of work to do. I think what's almost certain, in my view at least, is that there will just be a lot of increased disclosure, a lot of increased reporting that happens. Whether that follows through with increased capital requirements or greater limits on certain allocations or certain types of investment activity, I think that's too early to say. But I certainly think around disclosure, that's very likely to happen. And then I think topic we've talked about a couple times, AI, things around cybersecurity, on the underwriting side, right? For insurance companies who are underwriting risk and taking on risk from their policyholders, what kinds of exposure are insurers opening themselves up to when it comes to these very new kind of nascent technologies? And again, I think it's early days. I think it's too early to draw any real conclusions. But I suspect that regulators are going to be very, very attentive and very focused on watching that unfold too. So I think there's no shortage of things that regulators are going to be, paying a lot of attention to and call it the next 5 to 10 years. And there's been a lot of changes just in the last few years. But I think the things that we're talking about going forward, those are very wide-ranging and very far-reaching, and that's why it's going to be a multi-year kind of journey.
And looking at just other issues out there, what would be some of the emerging trends, sort of top of the list items that you think will affect portfolio construction in the next few years that you're discussing with clients that maybe isn't front and center today, but will be at some point?
Yeah, I think, something that is probably, it's fair to say it is more front and center, but I think the emerging trend, the reason I would characterize it as a emerging trend maybe around, private asset-based lending. It's been around for a handful of years, depending on how you look at it. It's a relatively recent phenomenon, but I think what it really underscores is insurers are very sophisticated investors. They are constantly on the lookout for ways to diversify their portfolios, which are generally, significantly exposed to corporate credit risk, right? And investment corporate credit risk in particular, investment grade, excuse me. And so anything they can do to source other types of spread, other types of return, and diversify their balance sheet exposures, that's going to continue. And so while private asset-based lending has been around for a few years and it's maybe not new to a lot of folks per se, that the emerging part of it is just what other exposures will they start accessing? What other exposures will they start accessing, or their managers? What other structures, what other types of collateral can you source and structure and compile in a way that provides that diversifying spread the diversifying source of return for insurance companies. So, things like right now, music royalties, aircraft finance, a lot of real asset underlying exposure. There are so many different kind of asset-based lending collateral types out there today, but who knows what will kind of be new exposures 5 years from now. So I think that's kind of the emerging part is I would imagine there will very likely be things that we haven't even heard of today that in 3, 5, 7 years time could be more prevalent and ultimately reach a point of maturity where it just becomes almost plain vanilla at a certain point. So that's kind of what I personally think about a lot and what we look at a lot, what we consider, and I think that'll just be a constant evolution, really.
Given the volume of potential transactions that you see over time, in your mind, what differentiates insurers that are consistently successful in navigating their environments? What qualities they have, what insights they have, what's their point of view that makes them successful?
Yeah, I think the number one thing that comes to my mind is not just a willingness, but almost an eagerness or a kind of very proactive, almost aggressive desire to evolve and kind of change with the times. Right? And I think those that are successful, certainly when you're talking about successful insurance investors, um, you know, I think what stands out to me in terms of their approach, their mindset, their framework is the desire to be at the forefront of some of these things. The not only willingness, like I said, but the kind of eagerness, the genuine desire to be on the leading edge, to be out front and uncovering new investment opportunities and looking for ways to make something work. Looking for ways to, okay, here's an investment opportunity. It's off the run. It's something that not many people have done. Maybe nobody has done yet. Rather than saying, no, we're not going to do that. No, it's not going to work. It's too risky. Well, look for a way to make it work, right? And actively seeking out ways to uh, optimize it and frame it and maybe structure it in a way that works for them. That to me is a sign of a very successful insurance investor. And I think of course a very risk management oriented mindset is of course critical. And that doesn't mean, by the way, it doesn't mean avoiding risk. It doesn't mean you're not taking risk. It just means you're constantly evaluating, am I being paid? Am I being compensated for this risk? Is it a appropriate trade-off between the return that I can achieve and the risk that I'm taking? I don't think that's would take anybody by surprise, when we're talking about insurance investors. But I think those two things, kind of that real desire to evolve and be on the cutting edge, and then that real kind of ingrained risk management mindset are the two things that are prevalent across, the most successful insurance investors that we see.
You touched on a few of the items here that, factor into, I would think, the investment style right now. Sort of interest rates, private assets, climate related issues. When you're advising chief investment officers or portfolio managers navigating that dynamic environment, what's sort of the overall message in just approaching the whole process?
Well, I think if there's one, message to draw from that is really just you have to be flexible. I mean, you have to be willing to not only acknowledge but embrace the fact that things are just constantly changing. The kind of the ground is always shifting under your feet. There's always, we talked about regulatory developments. We talked about technology developments and AI, and you talk about not just regulatory insurance regulation. We talk about broader financial regulation, and sort of the indirect impacts that maybe things happening to two or four retail investors have indirect implications for institutional investors like insurance companies. That it's just a constant state of flux, right? Things are constantly changing, and so we could be having a conversation with a client today, we could be doing some analysis on their behalf, doing some work, giving them some asset allocation advice or what have you. And something could change in a week, in a month, in a quarter, in a year, where not that you expect that work to be completely rendered irrelevant, but just that when new information arises, you have to be ready and willing and able to adapt. And I think that's really the number one thing that we talk about a lot. We really encourage our clients to, like I said, embrace it. Not only accept it, but embrace it. Because again, if you're able to do that, if you're able to embrace it, you're setting yourself up for success. You're setting yourself up, to be ready to act and maybe take advantage of some opportunities ahead of your competitors. So I think that flexible mindset is really, top of mind for us and what we talk about our clients about.
Peter, thank you for joining us today and for sharing your perspective and valuable insights. And to our listeners, thank you for tuning in to Compound Insights from CFA Society New York. I'm Gary Farber, and we look forward to bringing you more conversations with leading voices in finance.